Amen.
Amen.
Amen. So, Joseph, we are going to pass it over to you. Again, if you guys are here for the financial classes, we are talking about planning for the future. We do this every other week. We have our midweeks. This is the Bronx and Harlem. And Joseph and his crew, they've been doing this in the Westchester ministry. And I'm going to just let Joseph introduce himself and tell us who he is and why he's here and what he's going to teach us. So let's prepare our hearts. Go for it, brother.
Thanks a lot, James. Thank you for the introduction. Good evening, everyone. I hope everyone is having a great week so far. I hope everyone is staying cool with this hot weather and now this smog or fog that we're getting with these Canada fires, and just hope everyone is safe or that is not with us tonight. For those that don't know me, my name is Joseph Edmonson. As James mentioned, I am a member of the Westchester region. I married to my wife, Penelope Moreno, who a lot of you may know. We have two daughters, Chloe and Sophia, who are our bosses and are now 3 and 5 years old. And it's an honor for me to come and have the opportunity to chat with you guys tonight, and hopefully allow everyone to be able to take at least one piece of information away tonight that can help you in your own financial journey. How we got here today is that a few of us came together last year in the Westchester ministry that has some sort of connection to the finance space as far as our 9-to-5 jobs, and put together a committee to try to educate the Westchester region on different topics in finance and financial planning. And then Maurice actually reached out and asked if it was something that we can do similar for the Bronx and Harlem region, which is how we got here today. So I'm excited to hopefully give some good strategies and thoughts on just thinking about the process of investing and what you want to start to consider, whether you're someone that's already been investing for a while and on the back end, someone that's retired, whether you're someone that maybe just starting out, or whether you're someone that's kind of in the middle where you're in the accumulation phase. And so my background as far as my 9-to-5 is that I'm a certified financial planner. I work with a company called Capital Management Group here based out of New York City. We are a financial planning firm that handles not only investments for our clients, but we also do risk management, insurance plan, and then also just comprehensive advice-based financial planning. I've been doing that now for 19 years. Prior to working in the financial planning space with primarily individuals and business owners, I was in the accounting space. I graduated from the University at Albany and got my degree in accounting, and did that for about 5 years at PricewaterhouseCoopers, which is one of the larger accounting firms in the U.S. And just being a first-generation college graduate and growing up in the South Bronx in public housing, and graduating with an accounting degree by default, when I came home and started working, everybody thought I could do their taxes. And everybody would ask for help around just general financial planning, guidance, and advice. But because I was working in this very demanding job and just didn't have the time to do it. And so I prayed on it, and God allowed me to make a decision back in 2006 to transition my career to actually do what I do on a day-to-day basis, which is help individuals to try to make smart financial decisions with their money. And that's what brings me here today. And I enjoy what I do. I enjoy helping people, and it's been a blessing to be able to give back to my clients and those that I do work with. My partner Ate is actually on a flight back from Chicago, so he may or may not join today. We have done this presentation in the past, so if he does come on, you'll probably see him at some point drop in. But we all know, for those that have traveled to Chicago to New York, there's always delays and always traffic with the airplane. So optimistic that he'll get here, but if he doesn't, I'll definitely share with him any questions that may have come about from today's discussion point. So I'm hoping to speak for maybe like 30 to 35 minutes or so, and then from there we'll open it up for some Q&A. Don't want to take everybody's evening. And what I want to just lay some more rules to say that this is not going to be a discussion about like what particular stock or things you should invest in, or something that's going to be unique to someone's own unique situation, because a lot of individuals in the room might be in different financial spaces. So the goal of tonight's presentation is to more kind of talk at a high level about just different things you want to think about as it relates to investing. And then, if there are more detailed questions that need to be asked, I could definitely make myself available, offline to speak and, talk in more detail about things that might come up around just specific questions around investing. So before we get started with investment principles, we want to start off with a couple of scriptures as we talk about planning for the future and looking at it from a biblical standpoint. So Proverbs 13:11 says, "Wealth gained hastily will dwindle, but whoever gathers little by little will increase it." That's a pretty amazing scripture, because it's going to really hone in on like a lot of what we're going to focus on tonight, which is about having a plan in place and not just being ad hoc with the way you think about growing your wealth and growing your money and growing your assets. Proverbs 21:5 says, "The plans of the diligent lead to profit, as surely haste leads to poverty." Right. So when we think about trying to grow our assets and grow our money, we want to have a plan and a strategy around it, and not just want to base it on just like, taking it day by day. Proverbs 24:27 says, "Prepare your work outside, get everything ready yourself in the field, and after that, build your house." So one of the key things, I think Derek Clay may have come on, I think a couple of weeks ago, and just talked about building a solid financial foundation. And that's one of the keys that we're going to talk about a little bit tonight too, is that you don't want to skip the process of thinking about investing without having a financial foundation set. It's almost the same way of like thinking about building a house and starting with the roof as opposed to starting with the core foundation. It's very important before you think about the aspect of investing, which does have risks, to make sure that there's a solid financial foundation that you're considering along the way. So, and I know the audience may be of many different ages in the group tonight, but I think this is a great, powerful slide to start out as you think about investing and to talk about the power of compounding. And really, one of the main takeaways tonight is that I want everyone to think about is that when it comes to investing or just saving for a goal in the future, the earlier you start, the better you give you a chance to actually reach that goal. So this particular example is from as it relates to the power of compounding, and it seems like it may not be true, but it actually is that this is an example of two different investors that are starting at two different times as it relates to putting their money away into the market or into an investment. And so the 25-year-old, which is investor number one, the 25-year-old setting aside $5,000 for 10 years. So they're pretty much putting away $50,000 over the course of 10 years. We're making the assumption here that they earn an average annual return of 8%, which is obviously not guaranteed in the market, but just for the sake of this illustration, assume that particular 25-year-old, by just putting away $50,000 for 10 years, and because they got an early start, by the time they get to age 65, it's projected here, assuming that this is a retirement account, that they would have about $787,000 based on a $50,000 investment over the course of 10 years, starting at 25. Now, we look at investor two. When we talk about procrastination and how waiting can hurt you, investor number two is actually starting investing 10 years later at age 35. And they're also putting away $5,000 a year. But as opposed to doing it for only 10 years, they're doing it for actually 30 years. So investor number two, starting 10 years later, is saving a lot more out of their pocket because they're saving for 30 years. And when you look at it, the investor that started 10 years later and actually saved $5,000 a year for 30 years, at age 65 ends up with less money. They end up with about $612,000 compared to the 25-year-old who, because they got that 10-year head start, and when you think about the power of compounding interest, that investor that's 25 got a head start and now was able to accumulate a higher asset level when they got to age 65. So while this may be a surprising chart for some of us, the key takeaway here is that anytime you think about a financial goal that's come up in the future, it's better to start now as opposed to waiting and delaying it, because the later you start, whether it relates to investing or saving for any type of goal, the more pressure you put on yourself to have to put away more of your money and have your money work harder for you, if that makes sense. All right, so we'll go to the next slide. So persistence is another example of why it's important to remain persistent when it comes to investing. A lot of times there may be individuals that think that, okay, I can invest one time and hopefully I get lucky and then my wealth will grow substantially and my assets will grow. In most cases, most individuals that have built up a good investment portfolio have done it by being persistent, saving a certain amount every month or every week or every year, and diligently putting money away, making sure that they're investing in things that give them the potential to grow, and not panicking when things don't go the way that we may project it to be, because we all know that when it comes to looking at the market just unfortunately doesn't go straight up. There's hiccups in the market. There's times where the market goes down, but persistence and what you invest in can be your best friend as it relates to your timing. So the impact of persistence is another hypothetical example of an individual saving $1,000 a year, or about $84 a month, which most of us could probably think of something that we spend $84 a month on that's probably waste that we don't need. And then this compares actually having different rates of return. So someone invested for 10 years, 20 years, and 30 years, and assuming that you have a 5% return, a 7% return, and also a 10% return. And again, it hits home to persistence and also the benefit of compounding interest that can benefit you. So if you look at the individual that's investing for $1,000 a year or $12,000, I'm sorry, $1,000 annually or $84 a month after 10 years at a 5% rate of return, that individual would have about $12,000, $578. In 30 years, that same individual would have about $66,000. If we go down to the individual that earns 7% rate of return, just a 2% difference, when you fast forward to year 30, you look at it's almost close to being about almost double. The individual that earned 7% would have about 101,000 compared to the individual that earned 5% and would have 66,000. If you bump up that to the 10% rate of return again, which is not guaranteed, the individual that was investing $1,000 a year for 30 years, $84 a month, if they were able to earn a 10% rate of return after 30 years, they would have about $164,000 saved. And again, this is not factoring in taxes, but assuming that the money is being invested in some type of retirement account. So the key to this chart is the aspect to take away from this is that when it comes to thinking about investing, whether it be for retirement or any other purposes, the key to investing is being persistent about actually putting money away. And the more persistent you are, the better chance you give yourself to accumulate a high level of growth on your assets. So when we talk about investing, there are a couple of key terms as it relates to like just managing risk. And when we think about investing, with the thought process that comes to mind is, okay, when you think about investing comes with risk that something that you put your money into, assuming that we're not talking about like a CD or a money market. Typically, if you're investing in something that gives you the chance to earn a 7%, 8%, 10% rate of return, there's going to be risk in the short term that if we're going through a bad stock market, that the market can go up and down. So one way to mitigate against turmoil in your investments is to do a couple of different things. One, we talk about diversifying. And what that pretty much means in plain English is that you want to prevent yourself from putting all your eggs in one basket, because the more concentrated your portfolio is, while that can potentially give you good growth, that also puts you at risk where if you are concentrated in a particular type of investment, there's a risk that you can see the portfolio fluctuating a lot more. Asset allocation, don't put your eggs in one basket. So there's different types of investments out there. There's investments that are in the US. There's investments that are internationally based. There are stock investments. There are bonds. There are mutual funds. There are ETFs. So the key to building a well-diversified investment portfolio is not tying your eggs into one basket and allocating across different asset classes. So if one particular area of the market is not doing so great in a particular time frame, if you're not 100% invested in that and you have your money allocated and mixed up, you hopefully get some benefit from being diversified in a diversified portfolio. It's almost like going into a supermarket. If a supermarket only sold oranges and that was the only thing that they sold, the likelihood is that they're probably not going to have as much revenue as a supermarket that sells everything that we try to go into the store for, because diversification is key. The term dollar cost averaging is an important term when it comes to investing. And what dollar cost averaging just means is that regardless of what's happening in the market, whether the market is doing great or the market is not doing so great, dollar cost averages means that you're putting away the same dollar amount frequently to take advantage of the aspect of getting discounts when the market is not doing great, but also buying less shares when the market is on the uptrend. So a classic example of dollar cost averaging is that for those of us that work at a company or that have ever worked at an employer, there's something called the 401k plan, which we'll talk about a little bit more. And what tends to happen in that case is that if you're contributing to the 401k, every time you get a paycheck, you'll see a deduction on your paycheck that says contribution to the 401k. And regardless of what happens, every 2 weeks, every month, or depending on the frequency of how you get paid, that same dollar amount is going into your 401k or your retirement investment. And regardless of whether the market is going up or down, that same dollar is getting invested for you. So that's where dollar cost averaging comes into play. And it goes back to the example of persistence, where you're getting certain money into the market or into an investment regardless of what's happening. And so the benefit of dollar cost averaging is that it takes emotion out of investing, because for all of us that may have seen different market drops, for example, going back to 2008 when there was a market crash, thinking about COVID when the market dropped about 30% in a matter of a week when everyone thought the world was going to end. Sometimes you can get very emotional when it comes to your money and you open a statement and see your account value being down. So the benefit of dollar cost averaging is that it takes that sometimes for most people the emotion away of saying, okay, when the market is doing good, I'm going to get money in. When it's not doing well, I'm not going to get money in. Dollar cost averaging almost to some degree tries to take that out of your hands. And so the benefit of dollar cost averaging is that it helps you to get money away and keep emotion out of investing. Okay. So when it comes to investing, we've probably heard of the term called risk tolerance. And what that basically means is that if you're someone that's investing or putting your money away to work for it to grow into the future, what is your tolerance for risk? And what we mean by risk is that what is your tolerance for potentially investing in something with the risk that it can go up and down in value? So, in an example of that, if you're investing in something that can give you a chance to earn 10% rate of return, well, what happens in the short term if in 3 months that investment, because the overall market is down, has a 20% drop? How would you react to that potential drop if you were investing in something like that? Would you panic and sell your investment? Would you kind of wait it out and see what happens? Or would you say, okay, if the market is not doing great, that gives me an opportunity to actually get more money in at a discount? So understanding your risk posture and your investment risk tolerance is going to be important to understand, like, what type of investment vehicles are going to make sense for you and what type of allocation. So if you're someone that is risk averse or you're considered to be a low risk taker, that means that you're probably going to be thinking about investing in things that may not give you as much of a potential return, but gives you less chance of decline in the periods where the market is not doing great. But there's a trade-off there. When you think about investing in vehicles that give you a lower rate of return potentially, because there's not a lot of fluctuation, that means that over a longer period of time, you may not put yourself in a predicament where you can earn a higher rate of return. So in that example, I would use like an example of a CD. For someone that's invested money for 10 years or 20 years and may not need it now, the benefit of something like a CD is that you might put money into a CD and you can get 3 or 4% on your money, but there's no risk of loss there, right? But is that CD going to give you the chance to earn 7, 8, 9, 10%? The likelihood is not. So as you look at that example, going back to the example of persistence, you have to understand when you're thinking about investing, what is the time frame of when you're going to need your money, and that should help determine what type of risk posture and what type of investments might make sense for your overall allocation to help to align with your overall goals. Okay, so Proverbs 10:4 says, lazy hands make for poverty, but diligent hands bring wealth. So basically what this, in financial terms, what this is basically saying is that, we have a lot of social media out there nowadays, and any given time we can get something on our phone, and there's a lot of bad information out there. And a lot of times, people will say, okay, well, I looked on social media and they said that there's this great investment, I'm just going to put money into it. And if you don't do due diligence to figure out if it makes sense for you, and you're lazy about it, that can cause some financial loss. So when you're thinking about putting money away, you definitely want to take do some due diligence to understand what's going to benefit you as it relates to like making your money work for you, and not just tie it to just like getting advice and not really putting some work in to understand what it is that you're doing as it relates to like trying to grow your assets. Okay. So we're going to talk about now shifting to talking about some different types of investment vehicles, but before, because a lot of times, particularly again in the world that we're in now, like there's a FOMO, or there could be a fear of missing out, where we say, okay, there's this hot stock or this hot investment that I heard about, and if you skip the process of having a financial foundation, that could hurt you to some degree, right? So what do I mean by having a solid financial foundation? So this is just like a pyramid. It looks a little bit busy, but the takeaway from this is that before you start thinking about putting your money to work in investments that can put you at risk of like your money growing, but also there can be some fluctuation, you want to make sure that there are certain things that you are aiming to have built in your foundation. For one, when you think about investing, when I talk to my clients about financial planning and investing, one of the key questions I ask is, okay, if you lost your job tomorrow or you didn't have income coming in, how many months could you go while paying the bills that are necessary? All right. So when I think about that, is that as a financial advisor, I tend to tell my clients is that before you think about, getting into the sexy stuff about investment, you should try to aim to make sure you're at a point where if you couldn't earn an income or something happened where your income is interrupted, you want to try to make sure you have at least 3 to 6 months of what your necessary expenses are in some type of savings account that is accessible to you. And why is that important? Because if you think about the aspect of like skipping that step and going right to investing, even if you actually have a good investment that you put into an investment that's growing, if you don't have a foundation set where you have emergency savings, and now we go through a period where the market is down, going back to the example of COVID, where the market dropped substantially in 2020 when COVID and the world first shut down. If you don't have that 3 to 6 month savings, or for some people it might be even more, and now the market is down and you now need to pull your investments at a time where the market is down, that could be a double negative sword where you're pulling money out of your investments at a time where the market is down, but then you're also potentially getting taxed on it. So when you think about investing and kind of wrapping that around and having a financial foundation, you want to think about where you are in your financial picture today and figure out, okay, where is my financial foundation? If I'm not at a point where some of my foundation is set, how do I map that in with actually thinking about growing my assets at the same time and don't skip that process? So it's important to get to a point where you have at least 3 to 6 months of your necessary expenses. Now, there might be some questions around what's considered necessary versus what's discretionary, right? So some of us might say, well, it's necessary for me to have HBO on my cable plan because there's a show that I love, right? But you have to ask yourself the question, it's necessary for me to have like the highest phone plan because I want to have the fastest internet. I want to have, access to everything, right? So, but you have to ask yourself, if there was a financial crisis that happened or there was a job loss, you have to look through your finances and say, what is truly necessary versus what's actually something that's considered discretionary, a need versus a want. So getting to a point where you build yourself up to have 3 to 6 months of your necessary expenses sitting in something safe that's not going to put you at risk of going up and down with the market. And it's okay if you're not at a point where you don't have that at this time, right? Because a lot of us are in situations where we might have children, we might have, expenses that come up. I feel like every time I go into the supermarket, everything is just much more expensive. So the first goal, if you're not at the point where you have 3 to 6 months, maybe aim to get to 1 month's worth of your necessary expenses saved. But going back to the foundation, you have to understand what your expenses are, right? So I don't see everybody on the screen, but just by show of hands, if I ask the question, do you know what your monthly expenses are, what comes in versus what's going on? How many people can confidently say like they have a good case of or understanding of where their money goes on a month-to-month or, day-to-day, year-to-year basis? So I see a couple of hands raised. And it's hard to track it, right? To be honest, right? Because in today's world, a lot of things, technology on our phone, a lot of it is automated, right? So it's very easy to get detached from your money, right? So when it comes to Uber, when it comes to eating, it's like before we had to pick up a phone to like call a taxi. We had to actually pick up a phone and have cash to pay for food. But now it's so easy to get detached from your finances that it's hard to sometimes track. So before we think about investments, it's important to have an understanding of where your money is actually going and to see if there's actually waste occurring. Because if there is waste occurring and you feel like you're not investing enough, if you take a look through where your money's going, you can actually find potentially resources there to actually put money to work for yourself in the future. So having a solid savings financial foundation, making sure you know what's coming in versus what's going out, making sure that you have the proper insurance. So as an example, if you're someone that has individuals in your household that financially depend on you and depend on your income, whether it be young children, whether it be a spouse, whether it be a parent, you want to make sure that you have the appropriate types of life insurance, that in the event you didn't make it home yesterday, I'd never like to use going forward, that your family is not put in a bind or a situation where they can't continue the lifestyle that your income would have afforded if you're still today. And all of us in the room are probably heard of a situation, seen a situation where someone has passed away and has not had the appropriate insurance plan in place to make sure their family was set and in a good financial situation. So making sure you have the right types of insurance, making sure that if there's a case of you're a homeowner, that if there's something, a repair needs to be happen in your home, and all of us have probably seen an example where something can break easily, that you have a financial foundation where there's money that you can tap that's not in your investment portfolio that is at risk of going up and down. Making sure that if you're someone that's actually still in your working years, that you have the right amount of disability coverage in the event that if you got hurt or sick and you couldn't work, that there's income that's going to be coming in based on disability coverage to make sure that you can still pay your bills, right? So these are just some of the key financial foundations that you want to take into consideration before you fast forward and jump to the aspect of investing and like trying to grow your wealth. All right, so let's talk about the aspect of when we talk about investing, there are different types of accounts that you can actually invest in to grow your wealth for the future. There are accounts that are non-retirement accounts, and then there are also accounts that are for retirement. And when I say the term retirement, I'm usually thinking about accounts that are typically geared for money that you're not going to think about using or touching until at least the age of 59 and a half. Because by IRS standards, 59 and a half is the first age, which in most cases you can actually take money out of a retirement plan where you may pay some taxes, but you avoid getting hit with a penalty. So in an example of thinking about a tax deferred account, a common example would be like a 401k plan at your employer. Or if you're thinking about a retirement plan outside of your employer, another example could be something known as a traditional IRA or a Roth IRA. These types of vehicles are types of investment vehicles where the government incentivizes you to put money into these vehicles to save for retirement. And while these assets are accumulating and growing in these vehicles, there are no taxes being paid. So you're getting tax deferred growth into the future. And depending on what type of account it is, whether it is an IRA or a 401k versus a Roth, that's going to determine when you actually get to retirement and start taking money out, whether you're going to have to pay tax or not. A taxable account, which could also be known as a savings account or a brokerage account, is a type of investment account where it's not a retirement account, which means that if you put money into a non-retirement investment account, whether it be a brokerage or just an investment account that you're saving money for in the future, when you do decide to pull that money out in the future, you're not getting penalized and you just have to pay taxes if there's growth on that money. So it's very important to understand when you think about the time frame of where you're putting money away for the future, what are you actually investing for? So if you're investing for retirement, should your money be going into a retirement account? If you're someone that's 30 years old and you're investing for money that you might want to use in 10 years, the likelihood is that you don't want to put that money in a retirement account because at that point you're only 40. And if you're investing in money in a retirement account like an IRA or 401k, you now decide to pull it, the government is going to come knocking on the door to say, well, not only are we going to take taxes from you, but we're also going to hit you with a 10% penalty for pulling money out for something that was going to be geared for a longer term purpose down the line. So what are some of the differences as far as the tax impact on contributions, the tax impact while the money is actually in the account and growing, and also the tax impact on when money is coming out? So when you think about a savings account as an example, right? If you have money in a savings account and that savings account earns interest, typically if you're someone that's working and you have money that gets direct deposited into a savings account, what happens before that money hits the savings account? You probably have some taxes that came out of your gross pay before the money hit the savings account. So you're taxed up front on money that goes into a savings account. And then at the end of the year, while savings accounts may earn some interest, even if you don't take that money out at the end of the year, we typically get something called a 1099, which means that even if you don't take the money out of a savings account or an investment account, the government or IRS is coming in and they'll say, because you earn some interest on this account, we want you to pay taxes on that all along the way, even if you don't use it. And the same thing on the back end, when there's now taking withdrawals, even if you are taking money out, you have to pay taxes on a taxable account when you're actually taking money out to use it if there's gains in there. Compare that to an account like a 401k. A 401k is a type of account or an IRA where if you have an employer, if you actually decide to put money into a 401k plan, the government is giving you the advantage of getting a tax deduction up front. So in the example of someone that is working at an employer and you make $50,000 a year, if you decide out of your own salary to put $5,000 into your 401k plan, when you go to file your taxes at the end of the year, the IRS is going to say, okay, you made $50,000. You decide to put $5,000 of your own money into your 401k. So we're only going to tax you on $45,000 of income. That $5,000 that you decide to put into your 401k, we're going to give you a tax advantage of deduction on that. So the benefit of a 401k or IRA is that the money that you contribute to it on the traditional side, it lowers your taxes today. Now let's talk about the accumulation phase while the money is actually in the account. While the money is in a 401k or a traditional IRA, that money grows without tax. So every year that money is in the account, and let's say you put $5,000 into the IRA or 401k, if 10 years down the line, that $5,000 has now grown to $50,000 because you've had some growth in it, you have not paid any tax on that money. So that's different from a non-retirement investment account where you might be paying taxes along the way. But we know that the IRS is not going to be friendly all the way through, right? So if they're giving you a tax advantage to give you a tax deduction up front, and then also they're allowing you to accumulate money while not taxing you over the years while you're working, now when it comes to the point where you get to retirement and you're at the point where you want to start taking money out, well, guess what happens at that point? When it comes to a traditional retirement account like a 401k or an IRA, excuse me, if you decide to take money out when you get to retirement, now everything that comes out is taxable at that point. So because you got the benefit of having a tax deduction up front, and because you had tax-free accumulation while the money was in the account growing, now when the back end, when you take money out in retirement, you now get taxed on that money. That's a little bit different from what's known as a Roth 401k or a Roth IRA, which is just you're, in that case, saying, okay, I'm going to forego getting a tax deduction up front when I make a contribution. So going back to that same example, if I'm someone that works at an employer and I decide to put $5,000 into a Roth 401k and not a traditional, and I make $50,000 a year, when I go and do my taxes, the IRS is going to say, you made $50,000 a year. Even though you put $5,000 into your Roth 401k, we're still going to tax you on the $50,000 that you earned. So you're not getting a tax deduction on the contribution in a Roth 401k or a Roth IRA, right? The same thing happens while the money is accumulating. You are not paying tax while the money is in the account growing. So if you're someone that's 30 years old and you've been saving money in a traditional or a Roth 401k for 20 years, you have not had any taxes that are coming out during that accumulation phase. Now, the main difference is that on the back end, when you get to retirement age and you have a Roth IRA or a Roth 401k, and you decide that you want to take money out, at that point, everything that comes out is 100% income tax free. So the government has, because they allowed you to get taxed up front with the Roth IRA or Roth 401k, everything that the money grows to in the future and everything that you pull out is all 100% tax free in all your money. So when you're thinking about where you are in your financial situation, you have to decide when it comes to investing for retirement, whether a traditional IRA or traditional 401k makes more sense compared to a Roth IRA or a Roth 401k. And a lot of questions depend on where your tax bracket is now, where it might be in the future, which might be unknown. If you're making a lot more money now compared to when you get to retirement. So there's a lot of unknowns around that equation. So it's always best to understand where you are to determine which one is best for you. And if you're not sure, it may make sense to put money on both sides of the table. So the key thing about different types of when you think about investing is that you want to make sure that you're putting money into the right type of investment vehicle to try to reduce the taxes that you pay over time. Okay. So let's talk a little bit about some different types of just conservative type of investments and some more investments that give you more potential for growth. So all of us I've probably heard of a high yield savings account. So this is just an account where you can put money into a savings account, whether it be online or whether it be at a bank, where you get an interest earning on it with no risk of loss. So right now, high yield savings accounts are paying anywhere between like 3.5% to 4% annually on your money, but they're not going to give you the chance to earn 7, 8, 9, 10% because they're more considered to be a safe vehicle for an emergency that might come up or money that you might need in the future. Same thing with a certificate of deposit or a CD. CDs are typically vehicles that you can lock in for 6 months or a year, which may give you a little bit more of interest than a money market would, but you tend to have to be locked into that particular period of time that you're going to hold the CD. A CD is not something that you're going to look to be earning 8, 9, 10% rate of return because it's more of a safe vehicle that's going to put you in a position where you're going to earn some interest on the money, but not have a lot of risk there. And typically a CD is going to be FDIC insured, which means that there's some insurance around if the bank goes under, that your money is protected up to a certain amount. Okay, so stocks are one way where you can actually start to think about investing in the market. So stocks is pretty much a way to actually own publicly traded companies where you can buy shares of companies directly in investment accounts. And when you are out considering buying stocks, you are essentially investing in companies with the thought process that based on the companies that you invest in and how they grow their profits and they grow their finances over the years, you're hoping that by investing in these companies and the decisions that the CEO makes, that you can also reap the rewards of being an investor in stocks. The way to invest in stocks is that you can be an investor in publicly traded companies. There are over 10,000 stocks or more that you can invest in individually, but when it comes to investing in individual stocks, it takes a lot of time and a lot of due diligence. So you just have to be cautious with when you're thinking about going the avenue of investing in individual companies, that you do your due diligence and your research. And again, go back to the scripture where you don't want to be lazy and just like look at what everyone else is doing, and make sure that you're understanding the risk of it as it relates to investing in individual stocks. There are different types of stock. There are common stocks, preferred stocks. There are stocks that grow higher than others, and there are like what are called defensive stocks, which may not grow as fast as other stocks, but tend to give you more of a steady growth over time. There are stocks that are large companies like your Amazon, your Apple, your Googles that are really big. There are small stocks. There are mid-sized stocks. There are stocks that are in the U.S. There are stocks that are internationally. So there's a whole gamut of different things that you can invest in that are not just tied to like one or two companies, but stocks tend to be more volatile than investing in bonds or CDs or money market and things like that. But they also, depending on what you invest in, can give you the chance to earn a higher rate of return. But again, you have to go back and understand what your risk is before you think about going that route of investing in individual stocks. So bonds are another type of investment, but they're a little bit more conservative than stocks. So bonds are considered to be like an IOU, where as opposed to having ownership in a company, when you buy a bond, whether it be investing in a government entity, investing in a corporation, you're essentially loaning the corporation or the entity money with the promise that you're going to get interest along the way. And at a certain point, you're going to get your original investment back. So a bond is like investing by way of like giving a loan and getting interest and getting the benefit of getting some potential capital return if the bond actually appreciates in value. So when you think about building a diversified portfolio and thinking about having a percentage of stocks versus bonds, typically if you're more risk adverse, your portfolio is going to probably have more bonds in it than stocks, because you may not be able to stomach the ups and downs that stocks and may give you. But if you're someone that's investing for a longer term time frame, and you also are someone that's a little bit more risk, not as risk averse, your portfolio might be in line where there's more stocks in it than there are bonds, because you have the potential to get more growth when you have a higher exposure to equities or stocks in the long run. So understanding like what your risk tolerance is, understanding when you're going to need the money, and understanding if you have a great asset allocation, those are actually more important characteristics than it comes to investing in like an individual company, because your asset allocation in most cases is going to drive what your actual return is compared to like what companies you actually pick. So if you pick a good company that's in the US, but the US stock market is not doing great, the likelihood is that you're going to get impacted by that. So it's important to understand, again, what is the time frame that you're investing for? When do you think you're going to need the money? How much time do you have? What is your risk tolerance? And do you have a diversified portfolio of different things that you can invest in to make sure that you're putting yourself in the best position to reach your financial goals? Okay. So another way to get into the market, if you're not someone that has an affinity or want to actually invest in individual stocks, is mutual funds, or what are known as exchange traded funds. These are just types of investments that allow you to, by investing in a mutual fund, invest in a basket of stocks at the same time. So it takes the pressure off of doing the research and due diligence to like buy individual companies, and it also allows you to get into the market at a much cheaper price compared to like buying a bunch of individual stocks. So mutual funds are a type of investment that allows you to build a diversified portfolio by owning a couple of different things at the same time. There are mutual funds that invest in stocks. There are mutual funds that invest in bonds. There are mutual funds that invest internationally. Again, there are like 10,000 different mutual funds that are available to invest in. And the benefit of mutual funds is that they give you the ability to be diversified in a diversified portfolio with a lower dollar amount, and also allow you to like not be concentrated when it comes to investing. Mutual funds have different types of metrics as far as like what their goals are and what they track. There are different expense ratios as it relates to mutual funds, but the key takeaway is that when you think about investing, if you're someone that's just starting out and you prefer to be diversified, you might be better served going around and looking at a mutual fund or what's known as an exchange traded fund, which allow you to invest in a basket of things compared to like investing in like one or two individual companies along the way. Exchange traded funds, just another type of diversified portfolio that tends to have a little bit lower cost compared to mutual funds, but also the takeaway of looking at exchange traded funds, which are, or also another word known as being ETFs, is that they allow you to invest in a basket of securities that have similar identical things to potentially allow you to grow your money. So one example, if you just raise your hands, has anybody ever heard of like something called the S&P 500? So the S&P 500 is pretty much saying that if you invest in a mutual fund or exchange traded fund that tracks the S&P 500, you're essentially investing in one fund in the biggest 500 companies in the United States by default. So as opposed to having to like individually go on and pick individual companies, an ETF or a mutual fund can allow you to be diversified in that example, where you can say, okay, I can buy an ETF that tracks the S&P 500, and by default, I can take $100 as an example, and I can be investing in the biggest 500 companies in the United States. And if the US, these 500 companies end up doing well, then I can see my money grow that way. And if there are periods where the market goes down, I'll see some fluctuation, but that might be less risky than me just buying like shares of one particular company, which may or may not be as diversified as being in a diversified exchange traded fund. So mutual funds and exchange traded funds is to give you a way to diversify and invest in a portfolio without tying your money to like individual companies. Okay, so alternative investments are just things that are outside of your normal stocks and bonds. So for some people, that can be real estate, it can be gold, it can be energy. For some people, it could be private lending. A new phenomenon that's come to the market in the last couple of years: crypto, Bitcoin, all these kind of things. Tech, pool funds. So when we think about alternative investment, these are just things that are outside of like your normal stocks and bonds that may or may not give you an advantage as it relates to diversification and volatility. But when it comes to alternative investment, if that's something that you tend to think about holding in your portfolio, you just want to make sure you understand the risk and make sure you do your due diligence before you think about going out of the realm of outside of the normal, stocks and bonds when it comes to investing in the market. Okay, so we talked about this a little bit, but just to put some numbers to going back to retirement, because retirement is so important, because when you think about retirement planning, for most of us, it's probably going to be the biggest thing that we have to save for in our financial lives. When you think about the aspect of, I don't even like to use the term retirement. I like to use the term of like, when you think about it, when do you want to be in a position to be able to be financially free? When do you want to be in a position where you have the option to work to be able to afford the lifestyle that you want to live? So for most of us, when we think about retirement, we have to think about when is it we want to get to the point where we can have an investment portfolio, have income coming in that can allow us to live the life and pay the bills that we need to pay in retirement. So because retirement is a big goal that a lot of us have to save for, the IRS is very generous in regards to what they allow us to put away into these different types of vehicles. So as an example, if you're someone that's under the age of 50, the IRS allows you to put $24,500 out of your own pocket, out of your own salary, into an actual 401k plan or a thrift savings plan, or what's known as a 457. You can put $24,500 from your own pocket into a retirement plan. And that's not including what might be the match that you get from your employer. If you're over the age of 50, they have something called a catch-up, which means that they allow you, because you're closer to retirement, and if you're in certain income limits, to put an additional $8,000 away. All right. So if you're someone that is able to put away the $24,000 plus an additional $8,000 into a Roth, you can get close to $35,000 away in a retirement plan individually. So if you imagine a couple being married, you can put close to $70,000 away into a retirement plan in 1 year, by way of just having a 401k and access to potentially an IRA. Something that's more new nowadays in the last couple of years, they have something that's called a catch-up or a super catch-up, that if you're in the age range of 60 to 63, the government now allows you to do an additional $11,250. Again, they're incentivizing you to be able to put this amount of money away, because the vehicle of saving for retirement is a big pot of money that you tend to have to accumulate. And we're in a situation nowadays where like less and less firms are allowing there to be the option to have pensions where you get a guaranteed paycheck for your lifetime. And more companies are going the realm of forcing you to actually save for your own retirement. If you're in a 457, which is usually a local or governmental entity, if you're a teacher, if you're a police officer, if you're a firefighter, the reason why a 457 differs from a 401k is that you may be in a position where you're able to retire before the age of 59 and a half. And a 457 plan is just a situation where you have a retirement plan that if you decide to pull from a 457 when you're 55 years old and you're retired, unlike having a 401k, you're not going to get penalized from a tax standpoint. If you take money out, you're just going to have to pay taxes when it comes to a 457 plan, but you're not going to get hit with that 10% penalty, because there's a case where if you're a teacher or a firefighter or a police officer, you might actually be retired prior to reaching the age of 59 and a half. So a 457 is a way to be able to put away for that purpose and be able to actually tap money before the age of 59 and a half. So definitely note some of these contribution limits, because when I've talked to clients in the past, there's been a lot of misconceptions about how much you can put away for retirement. So some people think it's 10% of your pay. Some people think it's 20%, but there's an actual number that the government sets every year, and it tends to go up a little bit. So when you think about it, you have to ask yourself, how much are you putting away for your retirement now? And are you also far away from it? And could you be doing more? Should you be doing less because you have other financial goals? And also, are you taking advantage of the possibility of getting a match from your employer? Because if you're not taking advantage of getting a match, where it says that, as an example, if you're working at an employer that says that if you contribute 3% of your pay to a retirement plan, we're going to match you and give you 3% also, that's 100% return. So if you're not doing that, you're missing out on 100% return on your money. So at a minimum, you want to think about, if you're not contributing towards retirement, you want to try to get to the point where you're at least doing like what your employer matches, so that you get that 100% rate of return on the money that they contribute on your behalf. All right. So it's important to understand the limits as it relates to like different types of retirement accounts. So if you have questions about that, we can kind of come back to that. So this is a little bit blurry, but this is basically looking at the different areas of the stock market and then more conservative investments by decade. So the first column is pretty much looking at the S&P 500 as an example. So what it's basically saying is that going back to the 1930s, always all the way up to the 2020s, if you hadn't been invested in the S&P 500 over these different decades, you've averaged about a 10% rate of return over that time frame. And there's only been two periods of time in the 2000s and in the 1930s where over a 10-year time period, you've actually would have seen a loss in that time period. When we think about the more recent example of 2020, had you been invested from the year pretty much 2000 to 2010, we had two big financial bubbles in that time period. We had the tech bubble crash where the market dropped like 80% in the 2000 period, where everybody thought the internet was going to be a big thing, and a lot of these companies ended up going bankrupt. And we also had the 2008 crash where Lehman Brothers went bankrupt, where the market dropped almost 50%. But even in those two periods where the market dropped substantially, when you look at being invested over a 10-year time period, your only loss was like a 1% loss. So the takeaway from this chart is that when you think about 10-year investing or more, the higher probability is that you tend to make money when you invest for a longer term time period compared to not making money. So when you think about investing, your best friend when it comes to investing is your time frame of what you have before you need to touch the money. If you're investing money for only money that you might need in a year, there's a lot more risk there, because there's always a chance that in a 1 year time period or in 6 months, even if you're in a great investment, the market could always be in a seesaw. So you just want to be cautious about when you're thinking about investing in the time frame, when you're going to need your money. And the longer time you have before you need the money, the more risk you can take. So if you're someone that's on this Zoom today and you're just starting out and working, you have more time frame before you're going to get to retirement. So if you're 30 years away from retiring, you don't want to have your money sitting in CDs, because you're only going to earn 2 or 3%, and you can be more aggressive because of the time frame that you have based on the market. If we compare the S&P as an example over the last 30 years or 40 years, where you have a 10% average return, when you compare that to like T-bills or 3-month T-bills, they'll only average about 3% rate of return. We look at kind of column 3. So the key takeaway from this is that when it comes to investing, time is your best friend. The more time you have before you need to access your money, and the better chance you get to have a better rate of return on your investments. So investing in the market has beat out a lot of other investments, whether it be gold, real estate, and the most important thing is inflation. When we think about inflation, you got to think about the aspect that if your money is in an account where it's safe and it's earning a rate of return that's lower than just the cost of living, you put yourself at risk. So we know for a fact that 20 years ago, what it cost to buy a gallon of milk at the store was much less than what it is today, right? So inflation can eat into your return. So if you have all your money sitting in the CD earning 2%, but the cost of living has gone up by 4% a year, even though you're not seeing an actual loss in your portfolio, by default, you're losing money by the rate of just like not even meeting the rate of return or rate of inflation. So that's why it's important that when you think about investing for the long term, you want to consider putting your money into vehicles that are going to outpace the inflation or the cost of living by default. So the key takeaway from this chart is that when you think about long-term investing, investments that give you more chance of return, when you think about time frame and the risk that you have from a longer term perspective, you tend to, if you don't panic when things are not doing great, give yourself a chance to have your money grow for you in the long term. Okay. So we'll end off here with just like thinking about some of the investment mistakes that people make. Emotional investing is a big mistake that happens, is that greed and fear come into play, right? So fear of missing out. And what emotional investing means that when the market is doing great and you're turning on your phone and everything is going up, you start to put money into the market. And then when the market is not doing so great, you pull your money out. So I look at that as an example. Think about when in 2008, just by show of hands, are there any homeowners that have been homeowners back in 2008 or in that period when the home real estate market crashed? There were a lot of people that made mistakes where when the market crashed in 2008, even though they didn't intend to like move out of their homes in that time period, they panicked and they sold their home at a lower value than what it was because the real estate market dropped, right? So you don't want to be emotional. When you're thinking about investing in the market, if it's money that you're not going to intend to touch for 10 years, if the market goes down 20%, you don't want to panic and sell at that point, because you want to wait for it to recover. Because if you sell at that point, you have to be right to get back in before the market goes back up. And it's very hard to what we call time the market, knowing when to get in, when to get out. If I knew how to time the market, anyone that does know how to time the market, I would probably be on the beach somewhere and probably not be on this call and enjoying my money. So the key to investing is that you don't want to be emotional. You want to make sure that you're not investing when things are only doing great and not investing when things are doing not so great. You want to have a solid game plan. Having a lack of diversification, you don't want to be investing in only one area of the market. You want to diversify your portfolio and invest in different things. It's great to be investing in U.S. companies or U.S. mutual funds or stocks, but you also want to think about international investing. It may be great where you might be investing in one company, but that one company may go down at some point. We've all heard of a company called Sears back in the days that used to be a great company, but that company went out of business. So anyone that was only tied to having money in that particular company, while they may have reaped the rewards in the beginning, they actually ended up not benefiting in the later term by not being diversified. Trying to time the market, trying to understand when the market's going to be at highs and lows is very hard to do that. So don't try to time the market. Ignoring fees when you think about investing, looking at the fees in your mutual funds and your ETFs, because higher fees eat into your actual rate of returns. Having no clear game plan when it comes to investing, just going about it, willy-nilly, again, being lazy about it. You want to have a solid game plan of why you're investing, and seek help and get guidance when you're trying to figure out, what your goals are. Chasing the great thing right now, chasing the highest returning asset that you might have seen in the news today, chasing hot stocks. It could be a mistake as well. Not rebalancing your portfolio, which means that basically, like, you're someone that says that, hey, I'm like a 50-50 middle of the road person, where I think that I am comfortable having 50% of my portfolio in things that are tied to the stock market, and I'm comfortable having 50% of my portfolio in things that are more conservative. If you don't do something called rebalance at the end of the year, you can find yourself being in a situation where you just put your portfolio away and don't look at it, that if the stock market runs up over a couple of years, you might find yourself now being, as opposed to 50-50, you can end up being 80% in stocks and now only 20% in more conservative stuff. So if we now at that point in time go through a period where the market has a big drop, you might find yourself being more impacted by that, by not rebalancing and making sure you're getting yourself back to being even killed. Too much trading, going into your phone and logging in and investing every day, unless you're a day trader and someone that's an expert at it, too much trading can be a negative to you. We talked about it at the beginning of our discussion tonight, waited too long to get started. Don't let fear or procrastination stop you from doing something to get started today, because again, the longer you wait, the more pressure you put on yourself to like have to earn more rate of return and have your money work harder for you. And then lastly, ignoring taxes. Again, if you're someone in the position, you want to understand when it comes to investing, we want the IRS to take less of our money, right? So if you're someone, again, that's investing for retirement, the best place to have your money that's invested for retirement is not money sitting in a bank account, because again, money that's in a bank account or in an investment account that's not in a retirement account, every year you're getting taxed on that money. So you want to think about not ignoring taxes when it comes to when you're investing in your portfolios, and understanding that if I'm someone that's investing in retirement, I should try to put my money into a vehicle that grows without tax while it's accumulating. So that should be like an IRA or 401k. And I want to understand what happens when I pull my money out, so that you can have your money in a diversified portfolio and put yourself in a predicament where you're having less taxes being taken out of your portfolio. So these are just some of the common investment mistakes that happen along the way. And you want to make sure you try to avoid these as you think about your journey. We'll skip the credit stuff for now. And I guess I'll stop there. I know we're at 8:28 right now, and I guess I can take a couple of questions at this point.
Yeah, good
Names
stuff.
of somebody's monitoring the chat. I can't see if
Yeah, I think what I'm gonna do, Joseph. Thank you so much for that. Since it is about 8:30, I'm gonna close with some announcements, and depending on you, Joe, how long you want to stay on to take any questions, if they have some, if after the announcements, if people want to stay on, how much time do you have?
yeah, I can stick around for another like 10 minutes or so after the announcements, just to take a
All right.
couple of questions
Cool.
if, for
So
those that want to stay
yeah,
on.
if you guys do have questions and you want to throw it in the chat, we can do that. But I just want to end with the closing announcements. Again, thank you, Joseph. There will be a quiz email to everyone to see if you got everything on there. No, that was a lot. That's a lot of information. And Joseph, I think there's probably only like a handful of people that are younger than you on this call. So I think that's an interesting thing to do too, because it's anytime you speak to anybody, where everybody's in a whole bunch of different places. So again, thank you. That was great. That was a lot of information. So I'm just going to go through all those announcements one more time. And again, if you have questions, you can put them in the chat, or if you want to hang out for a little bit. This was the Bronx and Harlem's midweek. We will not be meeting next week. We're coming back in 2 weeks after that, but we will not be meeting together on Sunday anymore. So Harlem, you guys at 10 a.m. You'll be back at PS 180. There's also a Zoom link for that, and it'll be on YouTube. The Bronx will be at the Evander Childs campus at 11 a.m. Also, we have the Harlem ministry, the Edge ministry is going to do the Coney Island little get together on July 25th. And they're going to be going to Coney Island, meeting there around 1:30. And if you want to get together at 125th, they'll be leaving there around 12 p.m. Amanda Britton is in charge of that trip. Also, as we mentioned earlier, you can still give your special contribution. We're about halfway towards our goal, and we don't want that lingering. So if you have any questions or issues about giving, please speak to somebody about that and continue to give special contribution. Campus is going away for their retreat on July 20th. They'll be in Minnesota. Our teen and preteen camps start on August 16th. And tonight we are actually extending just one last call for just going to late registration to go to camp. So for teen camp and preteen camp, if you want to register by tonight, we also have that registration available. So I'm just going to read through those prayer announcements real quick as we wrap up. I'm going to end the recording. There are some questions that are coming in there. Joseph, are you able to see those questions?
I'm trying to scroll down on my end, but it's
Okay,
not letting me come.
I'll read them out at the end, but let's just go through these prayer requests, and I think that's probably it with the announcement. But we were praying for Sharon Duncan's family, her father, Nolan Williams passed away. Charmaine Falcone's family, her sister Anna passed away. Cheryl Travis's father, Robert Campbell, was hospitalized with some heart conditions. Anthony Hernandez's family, his cousin, died in a car accident, survived by 6 children. Maria Lopez recovering from a car accident. Christine Finnerty's nephew Malik was in a serious accident in the DR. And the Agmanoyo family, Phoebe's mom, facing health challenges, and Isaiah is continuing his treatments and praying for Wendy and Peters. And I will close in a prayer. I will end the recording and we'll take a quick look at those questions.